Welcome to this week's Market Signals podcast. Happy to host Adam Turnquist here, Chief Technical Strategist at LPL, and happy to introduce our guest today, Tom Shipp, Head of Equity Research here at LPL. Tom, how are you doing today?
Doing great. Thanks, Adam. Happy to be here.
Yeah, we're certainly excited to bring you in. I thought, what an opportune time to talk a little bit of fundamentals and technicals. We'll compare and contrast where those themes are going in light of this recovery we've had in the equity market. And Tom, I know you're deep in the weeds in good old classic bottom-up analysis, but you also have your pulse on the macro environment as well. So plenty to talk about today. And we'll kick things off with the fundamentals and get your take and insight on really the fundamental story for this recovery. Maybe share some insight on the S&P earnings, where they've been, where they're at now, and maybe your outlook for earnings as we move forward.
Yeah, no, I think the interesting way to frame up how we've seen earnings estimates revisions for the S&P, and when I say revisions, I just mean the change in 2026 estimates from a few different periods, right? So I thought breaking it up from just the year-to-date period where we were, coming into the year to now, and then slicing that up into the beginning of the year to the end of February or the start of the Iran war, and then from that point to now. And I think there's some interesting things you see there when you break it up like that. We had approximately, what is it? We're at about 5.1%. So EPS revisions have moved up about 5% year to date. But interestingly, 3.7% growth just since the start of the war. And so that's almost counterintuitive, right? We've seen markets trade off and a lot of worries in the market up until, ceasefire and peace negotiations started. And, prior to the war, we saw estimate revisions growing to about 1.6%. So I think that there's a few different things going on there. One of them is obviously energy, right? So we saw energy sector revisions were slightly down coming into the war, and certain pockets had seen some stuff. We talked about oilfield services had kind of perked up a little bit, at least on the price side. But we weren't seeing it wholesale in the estimate revisions. Oil had still just kind of been doing not a whole lot. And since the war started, the energy sector revisions have kind of skyrocketed through 45% up from just the end of February. So a pretty big growth rate there. But remember that the energy sector is 3% of the S&P 500. So it's even with that level of growth, it's kind of accounted for. Some of my back of the envelope math this morning, on a year-to-date basis, about 20% of the S&P 500's revisions have come from energy. And you kind of fast forward that to from the start of the war to now, and it's about a third of the market's growth. Where is the rest of it coming from, right? It's coming from the tech sector. There's a few other sectors that have had subtle positive revisions, but 6 of the 11 S&P sectors have had negative revisions year to date. So I'd say those non-IT, non-energy positive revisions offset with the negatives, and you're really left with energy and IT. And like I said, from a year-to-date basis, it's about 20% is driven by energy, 80% by tech. Now, since the start of the war, call it 1/3 energy, 2/3 tech. I found that pretty interesting when you just kind of think of it right off the bat, but then you start to dig in and think a little further. Oil prices aren't really going to drive that much when it comes to tech demand and earnings, right? It's really driven by the top line and the growth we're seeing, and particularly AI compute, data center, CapEx build out. And I'm sure we'll touch on that a little bit more. And so that's really just been the big kind of theme here, is that growth has continued. Tech is driving the earnings growth we're seeing in the market. Energy is actually providing a boost. And, from there, you can kind of carve out energy, and it's just basically 100% coming from tech. And the interesting piece is, since the war started, that tech earnings revisions have accelerated, which again, kind of surprising at first. But once you start to dig into it, right, you get each piece of the onion, you're digging further and further. And it's really driven by the semiconductor complex within tech. And there was a few big earnings revisions or earnings reports that happened after March, right? So you start to get into a little bit more idiosyncratic pieces of information, but driven by semiconductor, i.e. compute, and the AI, compute build out data centers, et cetera. So surprised? No, maybe a little surprised that just the way the timing worked out, that in such a negative tape, you had actually such accelerating earnings revisions in tech, which really, like I said, drive the entire S&P. So an interesting kind of setup we've had year to date on the fundamental basis.
Yeah, certainly. When you think about the earnings backdrop collectively, although there's some nuance to those numbers, as you outlined, improving since the start of the war in a pretty big way. It seems like the market itself is getting back to the fundamental case and looking through the conflict in Iran in looking at those earnings numbers with some, we'll call it durability, especially when you think about the AI spend story. Tom, any thoughts on that alone? Just where are we at on the spending cycle? Has that really slowed down? And then maybe from a markets perspective, we've gone from how much are we spending on AI to this year being more of a question mark on the return on investment. What's the quality of that spending? Where are we at in that cycle and in terms of that question as well with the return on investment and some of that spending?
Yeah, I feel like there was a moment in time earlier this year where that scrutiny showed up, right? And we've had some pretty big debt issuances that were all oversubscribed, I believe, from a few of the hyperscalers and big spenders there. So there was a moment earlier this year. It seems to have gone now, right, where we're just really back on spending, and the demand levels are there. I think from the hyperscalers. So these are your Microsofts and Amazon and Google, who are responsible for building these massive data centers that they then rent out compute to other companies. The demand has remained very strong, right? So there's not enough supply of compute to keep up with the demand, and I think right now that is the narrative that's driving everything in the sense of the spend. There, are we going to see a high return on investment on this? I think that right now the benefit of the doubt is given to, well, if the demand is there, they're not going to sell something that they can't make a return on. Like this is fine. That's where the consensus seems to be on this, and folks just aren't generally worried too much on it, or maybe they, in the back of their head, they're looking at this as a cycle, but they know that we're nowhere near the end of that cycle. I think there's a few things to kind of start to think about where, if this is going to play out in any kind of capital cycle way that capital cycles have played out in the past, is one would be, is when does that spending slow down for reasons other than maybe demand, right? So bottlenecks. Hey, we thought we were going to spend $600 billion this year on a collective basis, but due to power supply and other, maybe more real world hard asset, real economy type bottlenecks, that they're not able to spend that. Does the market signal that as now they're not going to be able to spend as much, and so you just kind of stretch it out, or does the market ignore it? I think that's one piece to look at. And finally, I think the second piece is just the overall demand. Now, just from studying prior cycles, by the time that demand starts to slow down, by the time you would see it explicitly in numbers, the market will have sniffed that out, and I think we'll be on our way. So neither of those things have shown up just yet. So I think it's still kind of in this pedal to the metal, the middle innings, if you will, from that cycle. And in terms of just thinking about this from the customer perspective, right? Large enterprises, I think we're just really starting to scratch the surface on that. And larger enterprises slower to implement new technologies. So we've seen a lot of call it maybe anecdotal, or the market seems enamored with, a new capability that's come out, whether it's from Anthropic's Claude Cowork and some of these agentic capabilities. Right now, that's all the market is really focused on. Oh my gosh, these productivity gains are going to come because I've seen this amazing demo, right? But I think it's going to take time for that to flow into enterprises and for us to actually see productivity numbers really inflect from the economy writ large.
Right. So sort of a show me story, I think, still for AI. The adoption rate's relatively low when you look at it industry wide. Of course, the tech sector, much higher adoption rates, but there's a lot of runway. I think when you look at areas like healthcare, pretty low adoption rates. So that's probably going to fuel spending. And from your take, it sounds like the secular spending theme likely to continue for now, at least in terms of the supply and demand dynamics playing out in that space. All right, so we talked about the importance of tech. Curious your thoughts on valuations right now in the market. We've gone from near correction levels on the S&P, getting down to about a 9% drawdown. Earnings improved, as you highlighted, remarkably over this period. Where are we at on valuations? Does it make sense to you from your fundamental perspective?
Yeah, I'll set aside the making sense part for now. I think just to frame it up, we started the year at about 22 times 2026 earnings, right? So that level kind of came into the year with, and we stayed there throughout to about the beginning of the war, and the multiple started to retrace and compress then to about the end of March, right? So all of March was multiple compression. Went from 22 times to about 19 and a half times 26 earnings estimates. And what's interesting is during that time period, the S&P 26 earnings estimate actually went up like 3%, right? So we've gone up maybe 1.5% from beginning of the year to the start of the war, to use that same kind of breakup in the calendar. And then, so earnings growing 1.5%, start of the war to the end of March, earnings estimates grew 3%. So growing faster, but multiples compressed. That's that risk premium, war premium, whatever you want to call it, into the market. But on like a PEG basis or a growth adjusted PE basis, you had, the market had, ostensibly gotten cheaper. The interesting piece was the snapback that we all saw, and I'd love to hear your thoughts on that, maybe from a historical framework. But the snapback we saw, we were right back to 22 times. So we were right there, right? If you just looking at the PE on the market from end of the year, fell asleep for three and a half months, and woke up, hey, we're right at 22 times. What's happened?
Right, and I guess valuation reset pretty quick. Tech sector looked cheap briefly. I don't know if it still looks relatively cheap on a forward PE multiple, but it was below its long-term average for a brief period and is subsequently reset. But when you take, I guess, the fundamental story, you look at the technicals here on the S&P, we've kind of done the same in terms of the snapback. Of course, the price component a factor there, but this V-shaped recovery has been not unprecedented from a historical perspective, but certainly remarkable. We've gapped above the 200-day moving average and really never looked back on the S&P 500. That alone, when you're not filling a price gap over the subsequent trading days, is usually a pretty good sign of durable buying pressure. Of course, we've seen that in a big way. You look at the S&P, it's been up 12 of the last 13 sessions. Big tech making a big comeback as well. Tech sector not far from record high territory. Semiconductors breaking out on not only an absolute price basis, but also on a relative basis when you stack it up versus the S&P 500. So certainly a constructive backdrop for that group, for the sector. And I think for the S&P 500, it's the biggest sub-industry group. A lot of technical repair has been done underneath the surface of the market. That's been important. Something we've watched carefully. We call it market breadth. You look at how many stocks have recaptured their shorter term 20-day moving average. We were down mid-single teens at the lows at the end of March. We've gone back to about 80% of stocks now above their 20-day. Over half the index posted a new 4-week high last week. So it has been broad. It has been, of course, tech driven when you look at the contributions to returns off the March low. 6 stocks have drove about half the gains in the S&P 500, but those are importantly the 6 stocks, or most of the 6 stocks that drag the index lower. When you look at returns year to date to the March low, about 2/3 of those losses were driven by those mega cap names. So big tech starting to make a comeback here. I think that speaks to the durability of this breakout, and something technicians we've been watching for the S&P to clear that 7,000 point barrier. We tried several times earlier this year, and clearly without big tech participating, we could not get through that level. That was part of our thesis. We're not going to see a durable breakout until those names start to work. And for now, they're starting to work. And it was one of the reasons of many why we upgraded the sector last week. We, meaning our strategic and tactical asset allocation committee here at LPL. So tech got an upgrade to overweight. We upgraded our views on U.S. equities to overweight. So I think it's a pretty constructive setup technically. And then, Tom, I think you can make the case the macro backdrop looks better as well. When you look at Brent crude, there's really 3 things that we're watching for technically to really check the box for peak oil likely being in the rearview mirror. One of them, Brent below key support at 98. We checked that box. Implied oil market volatility also to come down, and that's been moving lower absent today's price action. Just for a reference point, it's Monday afternoon here, about 1:30 Eastern, and oil markets up 5 to 6% on some of the headlines around uncertainty with the ceasefire. But the Brent forward curve not reacting to the headlines over the weekend. So still trading lower. When you look out at the November, December contracts, they have not inflected higher, and those have been slowly moving lower. And that's the market telling us that they're pricing the pricing of a higher for longer oil regime likely not in play. And this is more, do I dare say the word transitory type of oil spike? We'll see what happens with the Strait of Hormuz and what happens with this ceasefire agreement that is set to expire tomorrow. Certainly a lot of headlines driving it. But Tom, just going back to the fundamentals here, we've had banks report. About 1/3 of the sectors reported, some more reports this week. Any insight or takeaways from the banking space from your perspective?
Yeah, what we saw is we didn't learn as much maybe as I would have hoped, and particularly from the big banks on maybe the Main Street economy, right? What was really the quarters came in came in good from an expectations perspective, broadly better than expected. The profit quality, I'd say, was skewed towards more capital markets, right? So trading, obviously a lot of volatility in the first quarter brings trading revenue. Capital markets, right? We've seen M&A pick up and an IPO window opening up. But as far as like your core spread banking, making loans to small businesses, consumers, et cetera, not a super clean story on a reacceleration there. But I think broadly good. Not anything super concerning there. No big red flags. Capital markets open for business. Credit hasn't really cracked, and commercial activity looks healthy. So of course, you get your CEOs expressing caution, being risk averse, saying, "Hey, look, there are macro uncertainties out there." Feel like we get one from the big bank CEOs every quarter, right? We're worried about clouds or the weather or insects, whatever it may be, and but
Cockroaches, I guess, right?
Yes, and we did see a bit higher credit card provisions at one of the large banks. So, but again, all in, nothing too concerning. A bit better than expected, and driven by capital market activity rather than core banking and lending.
All right, so bank earnings, we'll call it good enough with some maybe cautious outlooks outlined given the macro environment.
Yeah,
let's talk.
I'd also note too, just that when I noted that what was it? 5 of the 11 sectors have had positive revisions. Financials have been in that group. They are, it seemed like that trade kind of faded a bit from last year, and the stocks definitely kind of took a hit a bit with some of the interest rate moves we had. But it's from a earnings perspective, it is one of the positive stories here today.
Yeah, technically as well, I would say the broader banking space holding up very well. Had a pretty sharp pullback along with the rest of the market in March, and importantly found support right off the prior highs. And that's where buyers stepped up. And we've had a nice rebound in the banking space. I think that speaks to this rotation we've had back to more cyclical leadership. One of the puzzle pieces we were looking for to really assess how sustainable is this buying pressure. And speaking of the sustainability of the buying pressure, we'll switch gears a little bit and talk about sentiment and positioning in the market. A lot of people have attributed to this rally as being more mechanical or forced buying. Tom, what are your thoughts there? Got any color for us?
Yeah, well, I think we all are seeing a lot of the same things, but we definitely have a lot of different circuit breakers, if you will, when it comes to the mechanics of the market. And you've got your trend followers who your CTAs, they kind of we've seen them switch to the buy switch is flipped on. We've seen your risk parity or your funds and strategies that will look at the volatility of the market and readjust accordingly. Those are just now, I think, starting to buy. So I think there's still some buying there. And then retail, there's been back and forth on whether they tax returns are done, so maybe they're coming back into the market, or had they sat on the sidelines. I don't recall exactly what the latest from some of the sources that we look at here at LPL Research on the retail crowd. One interesting note was the level of hedge funds that had kind of taken risk off the table and then piled right back in, and also the long only community, how they kind of set out a lot of this entire move and just kind of doing what they should do, in my opinion, from a long-term investment perspective, just kind of sitting out and waiting. So from the sentiment broadly and positioning, I think that it's definitely been we know that there's kind of this underlying bid to the market with passive flows and into retirement accounts, and as long as jobs are holding up, there's kind of that mechanical bid underneath the market. But yeah, I haven't seen from just the positioning side anything beyond that to suggest that yes, this has been mechanical, but nothing that's kind of shocked me too much. I'd say we're on the sentiment side. It does seem that beta was where everybody was chasing. We saw lots of whether it be quantum computing or space and satellite companies, or a lot of things really go parabolic as soon as the whether it's truly an all clear or not. But once the all clear was read by the market as an all clear, these stocks have really led out of the gate, kind of in April.
Right. It looks like most have flipped the book from pretty short positioning on the institutional side going into this event and throughout this event, where you have CTAs or commodity trading advisors really stepping up and buying the market. I think Goldman Sachs noted in their research, if the market stays relatively flat, there's around 70 billion to buy over the next few sessions or this week's sessions, just given the kind of systematic nature of their buying. And then the retail crowd, when you look at where they were at going into February, very long U.S. equities to the mark of over 2 standard deviations in terms of their exposure. They're down to just over 1 standard deviation below their long-term average. So there's scope for some buying there as well. Tom, you mentioned this beta chase. Curious your thoughts. Has that changed the factor narrative where you're seeing leadership? We started the year more value oriented. There was this big, great rotation to value. Are you seeing a lot of changes there in the factors that you watch?
Yeah. So beta, momentum, and earnings revisions have been the leaders year to date. And looking at this on more of a long only, we kind of look at the long short side of factors, or the just taking the long side of the factors, where I tend to look at it. And those three factors, which you would kind of generally put onto a risk on positioning, given where we've been with the momentum factor, and we've been pretty risk on for the past 12 months. And then beta, really, and what we can see there is just beta can really, when it takes off, it really takes off, and so therefore you kind of bump the entire factor up, because these factor composites are generally equally weighted. So every stock in it's getting kind of the same weight. Interesting ones have been value and dividend as a factor still working, right? So year to date still positive. And you can attribute that to that great rotation. Also, energy and materials have been huge outperformers year to date, and those are highly represented in those value and dividend factors. And where's that coming from? What are the laggards? It's your low ball, right? So the opposite of beta, effectively. And then quality and growth have lagged, and so the growth part might seem counterintuitive to some. But when we're talking about a factor, we're really just isolating to that, that characteristic of earnings and sales growth. And, what makes up quality and what makes up growth, right? A lot of software, and software has lagged. Recently kind of got a bit back into it, but year to date, due to AI disruption fears, et cetera, it's really, dragged those factors down.
Right. Certainly people kicking the tires on software. I think the broader software index up 16% technically there, right at a major support level. I don't think you can quite wave the all clear quite yet in terms of this being a bottom in software, but I think an important step in the right direction. There has been this beta chase, Tom, as you mentioned. Any concerns when you look at we'll call it a meme stock type rally here? You had Allbirds I think that was last week, rally 600%. Does that give you reservations about maybe where things are at on this AI cycle, when you have names going from making shoes to now playing in the AI infrastructure space?
Yeah, no, that was an interesting one. I think it was, kind of built for a lot of headlines. The company had kind of already shut down their shoemaking operation, and this seemed to be like a bit of a way to almost like a relisting of a company that had intended to do this. So I don't know if that one is the best, but it sure made for some good headlines. I think broadly, to be honest, I think a lot of the meme stock stuff gets a little bit overblown in terms of giving us any real signal. Yes, it will give a signal that there's risk taking in the market. I think it's just kind of going to be a part of the market these days, right? We've got cheap, a lot of liquidity for just trading stocks. We've got cheap avenues to do that are built right onto your phone. And I think it's just going to be here with us. I don't think there's any systemic risk to these things. I think people who are playing in these stocks know what they're getting into, and so yeah, I don't go there, right? I don't generally look there, even if something does look interesting, right? If it's got too much of that going on, I'm generally turned away from it. But yeah, I don't know, but I think it's definitely a bit there for when you think about AI trade or bubble fears or whatnot, is when you start to see some of these companies that all they got to do is put an AI on their name. Well, I don't think Allbirds is the right example for that yet. We'll start to see maybe some IPOs coming and some other things to maybe tell us, hey, is there excessive, more than maybe assumed excessive risk taking in the market?
Right. Certainly seems to be a signal. Risk appetite is back in a big way. And probably I view it as almost a positive just for sentiment in the market. Maybe not Allbirds specifically, but just some of those names catching a bid. We'll switch gears a little bit because I've had a lot of questions on energy. Clearly, WTI Brent well off their highs last month. Signs that, as I mentioned earlier, peak oil likely in the rear view. We're not really concerned about $140 or $200 oil prices right now. So I've had questions look, is the energy trade over. It was working all year. It accelerated. We've had almost a parabolic move since December in energy, and now clearly a laggard. There's been some technical damage there as well. Not severe when you look at the energy sector broadly. It looks like your classic pullback from overbought conditions. There's a little bit of a bid coming in late Friday and in today's session with oil up. Tom, I know you worked in the energy space on the sell side, so I thought it'd be great to get your feedback on the energy space, kind of where the cycle is and where maybe there's some risk or opportunity.
Yeah, I think that's funny. We saw, the grand opening of the Strait of Hormuz last all 36 hours. So I think I think it's going to be choppy when it comes to like the oil price. I think I sit between nothing ever happens. Oil's reverting right back to $60 crowd, and your, commodity doomsayer, perma bears, and these supply chain snarls are going to, drive oil to $200. I think that there's a new, call it, risk premium baked in that probably won't go away anytime soon. Like you said, even on the curve out, still very, very backwardated, but we're not at levels that we were at earlier and before the war, right? We've got some risk premium baked in, and I think the easy, like, call it re-ratings, particularly maybe within the energy stocks, like the easy re-rating gains have probably been done. You'll probably need to look a little bit deeper for value, do a little bit of work, right? And as we wrote about earlier this year, you can kind of see this between the different kinds of returns in oil stocks, energy stocks. It's like, okay, hey, pure commodity beta, right? Oil beta, as I call it. And that's, those things will rip with the commodity, and that's what we saw. And depending on how sustained the market believes the oil rally to be, that's going to be the source of a lot of your oil beta and a lot of your oil returns. The next kind of group is ones where you think about, oh, well, is this going to last long enough for pricing pressure to come through to the system and bottlenecks to come through? And I kind of lump probably this part of the cycle we're moving into now is in with that. So you start to look at different parts of oil field services. Hey, do we think offshore is going to work versus North American shale and pressure pumping or hydraulic fracturing, etc. Like, where do you think those bottlenecks and pricing pressure will come up? I think that's kind of where we have to get. And disclosure, I was an oil field services analyst, and so that's really where I tend to go. But we look at everything here, and then finally you have maybe your third piece where it's a very long drawn out cycle, and you start to look for your tollways, right? Your pipes, your refineries, et cetera. So I think there's still value here, and that's mainly because I don't see oil going back down to $60, and sometimes they can trade that way. But I think it's going to be a little bit more idiosyncratic and getting position or waiting for pullbacks in certain areas. I continue to think that the capital, call it, efficiency and the quality of management on the E&P side, particularly for your independent E&Ps, like, they're not going to chase growth just because we had a few months of this going on. I think they're going to continue to be pretty resilient, pretty conservative, and focus on shareholder returns and value accretive projects. If we start to see that fade and we start to see production grow and rigs coming online, then maybe we'll say I fully expect that it's a cycle, and if we did get to that point, the E&Ps can't help themselves, and they would just absolutely, if the high quality ones aren't going to grow, then somebody will, right? And so the oil cycle tends to cure itself. But I think the broader bid to oil and just folks wanting to diversify oil supplies, I think that's here to stay for at least the next 12 months to 24.
Right. And we've heard from some companies talking about their drilling capacity and really not increasing or chasing this. Much different maybe 10, 15 years ago, where they would start spending, increase production. They've been more disciplined, to your point. I think we've highlighted before on our calls, this isn't your father's oil market anymore when it comes to capital discipline and then focused on their balance sheet and return to shareholders. So might look a little bit different this cycle, something I know you've wrote a lot about. And I think that's still your thesis as far as the latest from your research. But oil field services, when you look at it technically, I think 3.5% below record highs, held up very well despite oil coming lower. That's really where we see relative strength in the oil or the energy sector. The E&Ps were working. That trade has slowed down in terms of the relative strength. They're obviously, to your point, Tom, more exposed to price than the services side. So certainly an interesting spot on the services sector or subsector within the energy space. Tom, I think we are at time, so we'll wrap it up there. Certainly loved having your insights today and breaking things down on the fundamentals. So we'll be back next week for another edition of LPL Market Signals. So tune in then. Thanks, everyone.
Thank you.